Yep. Okay. Hi, good afternoon, everyone, and thanks for taking your lunchtime to join our webinar, titled Turning Points, for Bondholders. So today, we have with us our Philips Fixed Income Desk, as well as myself, who will be conducting this webinar. And as always, just a disclaimer that this is a sharing session and would be just for educational purposes. And this is not to be treated as a financial advice. So all investors and advisors are still supposed to do their own due diligence before making any investment decision. So let me quickly do a quick run through on briefly what will I be covering today. So first, we'll be starting off with a quick recap on the Singapore fixed income market during the first quarter, followed by the current interest rate environment and how it's likely to trend moving forward. And afterwards, we'll share a little on how will the movements on interest rate impact our government securities. And lastly, we'll throw in a few bond ideas to perhaps spur some interest before concluding the session with Q&A. So, without further ado, let's take a look at the bonds volume of Singapore for the first quarter of this year. So, previously, with interest rate climbing exponentially, it has not only caused like bond prices to be volatile, but also placed pressures on corporate credit health due to higher borrowing costs. So, however, just like the year of the dragon, Singapore new bonds issuance with the size greater than 100 million have started to pick up, with 17 issuances coming in the first quarter of this year, contributing to approximately 5.36 billion being raised. So unlike the previous years where the majority of the bonds issuances were made up by the banks, as most of them has benefited from the higher interest environment, which which give them the confidence in their earnings, enabling them to push forth with newer issuances last year. So this time around, it was a good mix of issuances coming from both banks as well as REITs and properties issuers. So if you were to take a look at this chart over here, I know you may think that, hey, why did you say that the issuances picked up while in first quarter of 2023 reflected a higher number? Well, it is true that the number of issuances did indeed pick up in the first quarter of this year with a total of 17 new issuances, like I've said previously, while the first quarter of 2023 only recorded 12 issuances. However, the amount that was being raised in the first quarter of 2023 was inflated due to the issuances from HSBC, specifically their 5.3% note, which has an issuance size of $1 billion. Thus, this has pulled up the numbers for the first quarter of 2023. So why did new issuances start to ramp up in the first quarter? Well, first, let us take a look at the current interest rate movements and its expectations. So in the latest FOMC meeting, which happened on the 20th of March, the Federal Reserve has stated that the economic activities are aligned with the dual mandate, but because the inflationary data points are still elevated, hence they have decided that currently it is still not appropriate to discuss any rate cuts at the moment, since they have not attained the confidence that they are looking for. And they have also decided to maintain the rate for the fifth consecutive time at a rate of 5.25 to 5.5%. So, before the meeting, I believe that the key thing that the market was looking for was the direction, if there would be any rate cuts to happen this year. So, since the past 2 months, inflationary data pointers wasn't the greatest, as it came in slightly above market expectation, with February headline CPI coming in like 5 basis point higher at 3.15%, and versus the 3.1% that was forecasted, while core CPI came in at 3.75% respectively. Yeah. Okay, sorry for the interruption. But yeah, so like I've said, the CPI came in slightly above expectation. So this has given rise to the worry of cuts happening this year to be taken off the table for the markets. But in terms of guidance, if you were to shift your attention to the left of the screen, this is the dot plot graph that was provided in this meeting. And in the first column, which is the year of 2024, the committee members have penned down the mean interest rate projection for 2024 to be at 4.6%, which is similar to the projection that was released back in December's meeting. And furthermore, I mean, Chairman Powell has also mentioned that the policy rate is likely at its peak for this tightening cycle. And if the economy continues to move towards the direction that they are looking for, then it will be appropriate to be to begin dialing back on their policy restraints at some point this year. So with that, I mean, I believe in the March meeting, the market has gotten the rate cuts affirmation that they are looking for. And it is likely that we should experience the rate cuts that will pen down during in the SCP. But also do note that, I mean, if inflation were to trend even higher, then the committee is prepared to hold the rates for a longer period of time or even raise rates if appropriate. Yep. So moving on, this is just an overview of the CPI and PCE graph. And as you can see, in general, inflation is indeed trending down despite the small upticks from the previous 2 months data. And the most recent CPI release for the March came in slightly higher at 3.5%. And I mean, although inflation appears to be stickier than expected, like what Chairman Powell have said, I mean, these are just small road bumps along the way before inflation can reach the Federal's target range of 2%. Yep. So moving on, this is the Fed Funds future curve, which indicates the market expectations for interest rate to trend for this year and the year subsequent. So in this graph, you're able to see two lines, one in the dark blue and the other in orange. So the dark blue line was the expectation that the market has made at the start of this year. And during the first FOMC, during that period, the market was rather optimistic and was pricing in for rates to fall approximately 150 basis points for this year, which is approximately around 6 rate cuts, and the cuts to come in as early as March this year. However, that wasn't the case. If you were to look at the orange line, this is the latest market expectation right after the March CPI was released last Thursday. And this has, I mean, because the CPI has came in slightly above expectation, this has prompted that inflation isn't trending down as fast as what everyone has thought so. So with that in mind, the market has become more prudent with their expectation and turned down from 6 to only 2 rate cuts have to happen this year. And this is much lesser than what the FOMC has projected for 2024. So if you to shift your focus to the center of the graph, in the month of July, according to Bloomberg's data points, the market is expecting rates to fall by 8.3 basis points from the current level, which hinted for a rate cut to happen during that period. But despite this, I would still believe that for any rate cuts to happen this year would probably be in the third quarter of this year. I mean, yeah, it is true that most recent the FOMC meeting projected there will be 3 cuts happening this year. It is likely that with the recent upticks, it might dwindle the confidence for the members to impose a cut that swiftly, as any premature cuts may unwind the previous tightening efforts that were being put in place. But will rates continue to pull higher this year? I personally don't think it will, as the members have also previously stated that they are comfortable with the current range that they are at right now. And if inflation continues to stagnate, then I believe the Fed would probably continues to just hold the current rate steady for a longer period of time and to keep watch of the data. But with that being said, I mean, anything could happen. And the possibility of interest rate trending even higher is still possible if there's a black swan event such as geopolitical tensions was to happen. Yep. So how will this impact our local government securities such as our SGS or treasury bills? I mean, as we all know, bond yields move in tandem with interest rates. So hence, if interest rates are projected to hover for a little longer this year, similarly, we should experience the yields of our Singapore government securities to hold at the current level for a little while longer, up until at least when the rate starts to show signs of improvement, then you'll start to see the yields starts to taper off slowly. So if you were to look at this chart, which is the yield curve for our 6 months treasury bills, you can see that the yield has been consistently between the range of 3.6 to 3.8%. with the latest cutting off at 3.75%. And the next 6 months treasury bills will be available for subscription this coming Thursday. And with that in mind, I believe that the cutoff yield should still hover around the same range of around 3.6 to 3.8%. Additionally, I think for investors who like to compare between T-bills as well as the fixed deposits from our local banks such as DBS, OCBC, and UOB are currently offering at a much lower rate as compared to what our government treasury bills can generate for a similar duration. Hence, I believe it will be wiser for investors to park their funds into government treasury bills instead of fixed deposits. So this is just a slide to show that right now both our Singapore and US yield curve are still inverted, which means that shorter dated bonds are still generating a higher yield as compared to longer dated ones. Thus, I believe that once the rate cut starts to take place, the curve will slowly flatten and turn back to normalcy, which is upward sloping. So moving on to bond ideas. Now we'll be sharing on the bond ideas for this seminar. And the first bond that we'll be sharing would be SPH REIT, 4.1%, which is also known as Paragon REIT right now. So this bond was announced back in 23rd August 2019, and it has a coupon rate of 4.1% and approximately 4 months till next refix. So it has a reset date at 30th August 2024 and every 5 years thereafter. So it also carries a reset rate of 5 years SOR plus an initial spread of 2.517%, and currently is trading at 99.5, which gives off a yield to worst of 5.449%. So for SPH REIT, we like it because it has a vigilant capital management. For its FY 2023 gross revenue, it went up by 1.8% year on year, while net property income went up by 0.1%. And this was benefited due to the resilient retail spending as tourism returned to normalcy. Its occupancy rate is also at at a stable level at 98.1% and a weighted average lease expiry WALE of 5.1 year. So this indicates that there are good demands for their properties. So for SPH REIT, 85% of its debts are fixed, which an average cost of debt at 4.3%. So I mean, you may think that 4.3% is slightly high, yes, because it's due to the current interest rate environment, but also this is in line with its peers within the same industry. And in FY 2024, they have a total of 523 million of debt that will be maturing. And out of this 523, 300 million of these debts consist of this 4.1% perpetual. And with currently they have a gearing of 30%, which is rather prudent, and an interest coverage ratio of 3.5 times. Hence, with that, I believe that the possibility of the recall for these notes is possible. And that's why we like SPH 4.1%. Next up would be CapitaLand, 3.65%. It's also a perpetual. So this bond was announced back in 10 October, 2019. And it has approximately 6 months to next refix. So, and it has a reset date of 17 October 2024 and every 5 years thereafter. It has a reset rate of 5 years SOR plus an initial spread of 2.2% and a step up of 1%. However, do note that this step up of 1% is only applicable from 17 October 2029 onwards. So for this time round, if let's say this CapitaLand 3.65 were to be fixed, you'll only be getting the an indicative benchmark yield plus an initial spread of 2.2%. So if you were to look, and if you were to take the 5 year SOR as a benchmark, which is currently hovering around 3.23%, if these perpetual notes were to be refixed, then you will be giving roughly around 5.43%. So I mean, for this, why we like CapitaLand, it's because if let's say this perpetual were to be resetted, then it'll be resetted at almost like way higher than the 3.65% that they have initially been giving out. And right now, according to the high interest rate environment, I don't think it'll be wise for I wouldn't say it would be wise, but it would be rather expensive for issuers to reissue, to roll over their notes. Yeah. So yeah, okay, this slide is rather interesting slides, as it is for those perpetuals that are callable this year with reset rates based on the Singapore swap offer rate, or SOR in short. So I mean, however, I mean the usage of why I show this slide is because the usage of SOR as the benchmark rate has ceased on 30th of June last year, and currently all the new issuance have with an reset rate will be based on Singapore overnight rate average, which is SORA in short. According to the Association of Banks in Singapore, or ABS, they were the ones who are in charge of the structuring of the guidelines from the transitioning of SOR to SORA. So in order for perpetuals in order for perpetuals that previously hold a SOR rate to transition to a SORA, the issuers will have to go through a consent of solicitation for the new proposed rate that they'll be giving to their issuers. So, I mean, during the discussion between the ABS as well as the issuers itself, as the industries itself, I mean, ABS have stated that, with regards to the transitioning, many industries have sought for a redemption rather than to a rollover by doing a consent of solicitation. Hence, I've came up with this list of perpetuals that are callable this year with the embedded legacy rate. So, I mean, I believe that this might be this might be of interest, I mean, for investors who are holding onto any of these bonds. But on a side note, I mean, although it's true that, although they said that industry have voiced that they rather do a redemption than to do a rollover. A rollover may still happen if the issuer choose to do so. However, like I mentioned previously, because they are callable this year, as well as interest rates are slightly, at quite a high level as of right now, I think it will be rather expensive for these issuers to do a rollover as well as do a consent solicitation. Hence, yeah, this might be an interesting slide for the bondholders of either of these notes. Yep. So in conclusion, the first thing I would say that rates are still expected to remain elevated for slightly longer, up until at least the third quarter of this year, while waiting for more meaningful data pointers. Hopefully by then, inflation data points will start to taper down slowly, and the Fed starts to gain more confidence in seeing that hey, inflation is indeed trending down before rate cuts will start to happen. If not, I think at this juncture rates are still expected to remain elevated. So for short-term play itself, I mean, for investors who who are still looking for high yield, slightly higher yield, and slightly at a safer investment, then I believe that short-term treasury notes are still a good play. This is to maximize the inverted yield curve. But I mean, do take note of reinvestment risk, because this kind of 6 months or 1 year treasury notes, it's only for a duration of 6 months. So by then, if let's say rates starts to taper off, then maybe the next time you're going into to do a reinvestment after your 6 months T-bills matures, then at a juncture, perhaps the yield that you're going to is slightly lower as compared to maybe the 3.75 at this moment. And lastly, I would say that right now, it could be a good time for investors to add in some duration into their portfolio, such as perhaps 2 to 5 years of duration. This is because since the yield curves are inverted right now, longer dated bonds yields are slightly lower. Hence, the price of these bonds are slightly below par. So it'll be good to lock in some of this some of these bonds at this juncture. And once the yield curve turns back to normalcy, then you'll start to see the prices of these bonds start to pick back up again. Yep. So yes, with that, I believe I can do a conclusion of this webinar. And if you're interested or you have any more questions that you'd like to ask us, or perhaps know about new bond issuances, you can just email in to us at bonds@phillips.com.sg, or scan this QR code to join our bond Telegram group. And yes, with that, perhaps we can move to Q&A. Okay. So for the first question, okay, did you say that perps callable this year are likely to be called? Why, please? Yeah, so like I've mentioned, because let's say, I wouldn't say all perps that are callable this year are likely to be called. I would say the tendency for perpetuals that are callable this year with the SOR rates, something like that. Yeah. As you can see, the reset rate, right, is based on SOR itself, because this is a legacy rate. So in order for this, if let's say for the issuer to do a rollover and not call back this perpetual, first they have to do a consent of solicitation. Then they will have to, you know, get approval from the shareholder, not shareholders, but the bondholders themselves on the suggested coupon rate that they are comfortable with. And second of all, I would say that because currently interest rate are still high, and the SORA rate is relatively high, which I think I showed you previously. Right now, SORA it's hovering around 3.23% for 5 years. So at a slightly, high interest rate environment, it will be expensive for uh issuers to do a rollover. Because if let's say previously you're paying 3.6%, right now, will you want to do a rollover to do a 5.23 or 5.4%? Yeah, it will be expensive. Hence, I believe that these factors would increase the tendency of this kind of perpetuals with the legacy rate to have a higher tendency of being called back this year. Yep, hope that answers your question. Okay. In what condition will the bond issuer roll over? Any indication metrics to show high probability that they will do a rollover? What to look out for? Whether the issuer sustainable if they do a rollover. Yeah, so I believe first thing first, you have to look at the financial health of the issuer itself. So I mean, let's take it for example, if let's say, for example, the worst case scenario, Lipo would like to do a rollover because first they're financial, because they're not profiting, they're making losses every quarter, every quarter, then this will be a red flag. So if they were to do a rollover, then you will know that, hey, this is something that I need to take note of, because they're not doing a rollover just because they like to tide through this period of time, but perhaps they really did not have the amount of money or to pay up the bond investors. Hence, they would like to do to not say to pay up the investors, but to do a redemption. Hence, they would like to they have no chance but to do a rollover. So, I mean, this is one thing that you should take note of, to check on the financial health of the company first. Then secondly would be, I would say, the debt matrix. Let's say the gearing of a company itself. If let's say the company is highly geared, but this is, I would say, it's based according to industry, because property industries will usually be highly geared, whereas for, let's say, banks would have a different kind of structure. They are based on, if I'm not mistaken, I think it's based on their Basel, if I'm not mistaken. Yeah. So yeah, different industry has different ways of looking at it. But first of all, you have to look at is if the company is making money. If they're not making money, then that will be prompting you to say that, hey, perhaps I should take a step back and look, maybe if the rollover it's a right move for them, or perhaps it's an indication that this is a negative rollover in a sense. Yeah. Yeah. I hope that answers your question. Okay. Uh, any recommendations for bond funds or MMF? Right now, I wouldn't say I have any recommendations for bonds fund because as our bond desk, we mainly focuses on wholesale bonds itself. But MMF, I believe it is still feasible, as right now the rates are still intending to hold slightly longer. Whereas bond funds, yeah, for this, I'm not too sure for because like I mentioned, we focus just more on wholesale bonds itself. But perhaps maybe you give me some time, I can get back to you on this question. Okay, which is your view is more likely? A, interest rates starting falling in 2024, longer term trend around 2 to 3%. Interest rate will remain 4% over the longer term. The future remains inflationary. Okay, so regarding this question, personally, my opinion, I personally think that, hmm, I believe the chances of interest rates to fall in 2024, there, there is a possibility because right now you can't hold inflation, you can't hold rates too high for too long as it will cause a stagflation. So, and I believe the Fed also knows about this. So that's why they said that they are confident in the current the interest rates range that they are at right now. However, they will have also mentioned that, they really think that, it's a good point in time as of now to start looking at the possibility of cutting rates, because gone were the days where interest rates were at like what, 9%, 7%. Right now it's trending all the way down to 3+% or even to high 2s% as of certain months. So I believe that the probability of having an interest rate cut is still there for this year. However, for it to happen, uh, let's say let's say in a few months' time, I would say it's unlikely because, like I've mentioned, the Fed wouldn't want to do it too prematurely, because if let's say they would cut it too quickly, inflation will start to spike back up. Then it would literally unwind all the efforts they have put in place earlier. However, if let's say, just because right now, this few months is just showing that inflation is still rather sticky at the moment. But if let's say subsequent months, you can start to see inflationary are slowly dwindling down, then yes, I believe that this will build up the confidence for them to cut rates, perhaps in the third quarter, or maybe if let's say if more data pointers is more required, then perhaps in the fourth quarter of this year. So yes, I believe my view is that interest rate has the probability to cut this year. I hope that answers your question. Thank you. Okay. Okay. Can you elaborate more on the consent of solicitation if they want to do a rollover of their perps? What is the process? How long will it take for this process? To take place? Does it include a simple form to sign? In terms of, let's say, the how to say, the whole overview of the consent of solicitation, I believe, okay, ABS have not really shared in terms of how this consent of solicitation will be for every individual company. However, they have given, let's say, for example, let's take example just now, the CapitaLand 3.6%, 3.65%, and previously it's using 5 years. So if let's say CapitaLand would like to do a rollover, then first they have to do a consent of solicitation, which they have to seek approval from the bond investors. But for the interest rate that the new coupon rate that they are giving to the bond investors, right? The ABS have suggested perhaps, because since SAW is has a slightly higher percentage as compared to SORA, so ABS have suggested perhaps a 0.1% increase. So if let's say, for example, right now, 5 year SORA is 3.23%. then perhaps the next, if let's say CapitaLand would like to do a reset, for example, let me bring it up the page. Yep. For example, for this, if let's say CapitaLand would like to do a reset, then you can just take an estimate that CapitaLand would take 3.23%, which is the current SOR, plus a 0.1% spread, which is what the ABA have suggested to take into consideration difference between SOR and SORA, plus the initial spread of 2.2%. So roughly you'll get around 5.53%. And this is the coupon, the new coupon rate that CapitaLand will have to suggest to their bondholders. And then they'll have to come out with the announcement and perhaps request the approval from their bond investors. And yes, I believe it will be like a form to sign for their bond investors for this new coupon if they choose to do a rollover. Yep, I hope that answers your question. When yield curve back to normalcy, short-term rate drop, but does long-term yield drop from current high rates environments or stay the same? What has long-term rates been like when rates were low? Or we see short-term drop much more than long-term rates to get curve uninverted? Yeah, okay. So yes, regarding this question, right? Short terms, once when it's back to normalcy, right? Short terms will drop much more quicker than longer dated. That's why, like I said, right now it's inverted, which is downward sloping. Once rate starts to taper off, then people would starts to put more into longer dated bonds and request for higher, because now the economy, if let's say rate starts to cut, then economy starts to be brighter, then people are much more certain about the future. Hence, they're willing to park more into longer dated bonds. Hence, you'll start to see the slope starts to flatten out. Then that's why I said that the shorter yield will start to decline much faster than the longer dated, where the longer dated perhaps might hover or increase slightly. That's why from the inverted, then you'll be flattened, then you'll be upward sloping. Yeah. I'm not sure if you get what I'm trying to say, but yeah, that's like the logic behind it, where the inverted yield curve turns back to normalcy to be a normal yielding sloping curve. Yeah. Thank you. Okay. Let's see. Do you see more interesting bonds issues in second quarter of 2024? Yeah, I believe so. Second quarter, I wouldn't say like specifically which company or what, but as you can as I mentioned earlier, because previously it's where interest rates were sky high, only banks were the ones they're issuing because they have the capability to do so. However, right now, as you can see in this year, there's a mixture of REITs as well as properties as well as banks. Hence, let's say perhaps in the second quarter where rate starts to starts to be much greener in a sense, and maybe moving to a third quarter or so on and so forth, then where rate starts to taper off, then it'll be less of a pressure on the issuers itself. Then you'll start to see more issuances from different kind of issuers, and perhaps like let's say more REITs companies are starting to issue to do their acquisition, raise funds to do acquisition or something like that. Yeah, so I believe that there should be more interesting bond issuances in the second quarter of 2024. However, like I've mentioned, that right now it's still good to look at some bonds of perhaps 2 to 5 years or 2 to 3 years to lock in them first, like when they're trading below par. So I mean, once interest rates starts to taper down and yield curve starts to become upward sloping again, then the prices of these longer dated bonds will start to pick back up again. Yep, I hope that answers your question. Okay, you suggest to consider 2 to 3 years duration. How does that compare to 7 to 10 years duration, given that long duration bond is much more sensitive to interest rates? Yeah, so for me personally, I would say that 2 to 5 years, it's usually more or less, okay, if you were to take a look at this. Yeah, so usually for two to 5 years, right? It's between, I would say, the rates will be much more stable. And like what you have mentioned, it's true that for 7 to 10 years duration, given the long duration, this will be much more sensitive to interest rate changes. Yes. So that's why, I mean, in terms of certainty wise, as well as the bond price movements, personally, I would prefer 2 to 5 years duration rather than 7 to 10 years or even longer dated than that. Because if let's say you buy 7 to 10 years at maybe 2% previously, where interest rates were at all-time low, and right now, if let's say right now interest rate goes all the way up to 9%, and you're locking that 2 to 3% for 10 years, then yeah, the prices of these bonds will definitely decline drastically. So at least, for 2 to 5 years, there's still a bandwidth for you to play it out. Or let's say if you're really not interested, then you can just let it go in the market. And you won't be, that affected by the price volatility at that point of at that point of time. Yeah, I hope that answers your question. Okay. Okay. Can you share what is the risk to reward in bonds compared to other instruments of investment? Yeah, so first off, before you invest in bonds as compared to other investments such as, like, let's say stocks, or let's say it's options, or ETFs, or something like that. First, you have to know about the different, I would say, the risk level of different products itself or instruments itself. So I mean, for stocks itself, yes, there is you're super affected by the price volatility of the stock itself, where it goes up and down in the market every day. It's true that bond prices also do go up and down. However, if let's say you were to buy a 250,000 bond itself and you hold it, and if the bond has a maturity date, then even though you hold a 5 years or 3 years bonds, for example, and the price fluctuates, and let's say it goes below par at the moment, but you know for certain that you don't have to liquidate your bonds at the moment, and account for the loss in capital at this moment, even though your bond value might go down. Because if you were to hold a bond to maturity in 2 to 5 years time, for example, you'll get back your full principal sum lah. That's if you invest in a bond with a maturity lah. However, if you were to invest in a bond, a perpetual bond, then it'll be similar to investing into stocks itself, because there isn't a maturity date where you will know for a fact that you'll be getting your full principal back. However, in terms of that risk level between a perpetual bond and the stock itself, then is dependent in the state of, let's say, if the company goes into liquidation, then first you'll know that they will pay off their debts first, then comes the bondholders, then finally their shareholders. So in terms of the hierarchy, bondholders are placed above the shareholders. That's why I would say that there's a premium in in investing a stock, because you're taking much more risk in terms of the repayment if the company goes bust. That's why you're being rewarded with a higher return as compared to bonds, whereby sometimes you might say that, hey, bonds might be lackluster, giving like what 3%, 5%, when I can do like what 10% or more in the stock market. But it's because of the difference in risk level. That's why that you're being paid a slightly lower premium as compared to stocks itself. Yeah, I hope that answers your question. Okay, meaning to roll over perpetual bonds, the yield was surely higher than existing one, correct? For this question, right, at this juncture, I would say at this juncture, perhaps this year and next year, yes, because interest rates are still high and SORA rates are still tagged to interest rates. So when they are resetted, let's say for example, let's say for example this. So when interest rates are high, this SORA rate will be high. However, if let's say the bonds, this perpetual have a reset date at perhaps 2027, 3 years from now, or 4 years from now, let's say 2028, then by then, who knows, perhaps interest rates might go all the way down, like, to the lows when perhaps even like similar to COVID period or slightly above COVID period where interest rate were really low. Then if at that point of time, right, they were to reset, then the SORA rate will also be low as well. So that you have to take note. So during low interest rates and the perpetuals are being resetted at that juncture, then there might be a chance that when this perpetuals being rolled over, their yields might be slower than the current coupon rate that you are getting at the moment. So this might be this might incentivize incentivize the issuers to not call back this perpetual and continue holding it. Because previously, if let's say you're giving 3.65%, and right now perhaps SORA rate is only like 1%. So if you take, for example, this example, 5-year SOR is at 1%, initial spread is 2.2, and the totality will be around 3.2%. It's much lower than the 3.65%. Then it'll be wise for the issuers to do a rollover than to do a redemption of these bonds, because the yield might will be lower than the current coupon rate they are getting. So to answer back to your question, meaning a rollover perpetual bond, the yield will surely be higher than the existing one. I would say no, that is incorrect, but it really depends on the juncture where interest rate, is it high or low? At this juncture, I would say for this year and next year, interest rates are still slightly elevated. So there might be a chance, okay, for this year, there's a high tendency that the reset rate will be higher than the current coupon rate because interest rates are high. But for next year onwards, it might be be reset at a similar level, or there might be chances that it might be lower. So that part, yeah, it's still uncertain. Yep, I hope that answers your question. Okay. Can you elaborate? Okay. There's this question. What influenced the initial spread? So if you're saying about this initial spread, for example, this initial spread is based on the issuance date itself. So for example, let's say right now, if we take a 5%, how do issuers calculate the initial spread? Is, let's say for example, if today they were to issue a bond at 5%, for example, and today the SORA 5-year SORA is at 3%, so the initial spread will be 2%. So basically, it's just the coupon rate minus away the current 5-year SOR at the issue date itself, and you will get the initial spread. And this initial spread will not change for the whole entirety of the bond. So yeah, I hope that answers your question on what influences the initial spread, because the initial spread will not change, but it will be determined on the issuance date itself based on the SORA rate at that day. Yeah, hope that answers your question. Okay, give me a moment. Yep, a question from Stephen. Why does interest rate in Singapore always pivoted to US interest? Why can't Singapore interest rate take into consideration in Singapore economics factor with MAS guidelines? Yeah, I would say that Singapore interest rates has some correlations with the US interest rates movement. Previously, I think back in my first quarter credit outlook, we showed a graph lah. So basically, there is some correlation, but it's not 100%. So yes, Singapore interest rate tends to follow the US because we all know that there's a saying lah where you know where the US sneezes, then the neighboring country catches its cold. So yes, usually because you know most countries follows the US interest rate at some relations lah. So I would say that we uses them as a benchmark in some sense, but not completely. Yeah, I hope that answers the question. Yeah. Okay. Where can I get the latest SOR or SORA rate? I believe. For this, in order to get the SORA rate, it will be based on Bloomberg. If you have Bloomberg access, yeah, then you can search it on Bloomberg access. But if let's say you want to search it online, I don't think you're able to unless you call into your broker if they are able to assist you with that, or you can call in a bank to ask for an indication of the SORA rate at that day. Yeah. If not, most of the time you'll require a Bloomberg access to achieve to attain the SORA rate. But for SOR rate, there's no SOR rate anymore because it has not been updated since 30th of June last year. Yeah, I hope that answers your question. Can elaborate a bit more on Paragon REIT 4.1%? Yeah. So for this, okay, so basically why we want okay, not why we want, but why I think SPH rate 4.1% is interesting because first it's using a legacy rate which is 5 years SOR, so back to what I've said previously. And secondly, Paragon REIT has a very prudent gearing of 30%, which I think in the latest, according to their management, is actually 29%. So 30% is a round up. So for REIT to have a gearing of 30% is relatively prudent in my point of view, and have interest coverage of 3.5%. And I believe in my if I recall correctly, right, in one of their meetings, I think it was just last year, one of their management during their meetings with their management, one of their management have said that, you know, they have already some sort of like, you know, have some certainty, you know, that there is a high tendency that these perpetuals is redeemable this year. So with that, I believe that, you know, this SPH 4.1% is worth to take a look lah, when they said that, you know, yeah, something like that. And be it that, like I mentioned, in terms of their gearing, their cash, as well as the interest coverage, is more than within their means like, to be able to call back these perpetuals. Hence, that's why I believe that for this Paragon 4.1% is worth the look. Yeah, I hope that answers your question. Okay. Uh, any thoughts on how possible Iran-Israel conflict would impact on bonds? Okay, in terms of that, let's say if, okay, unless you're holding onto bonds that has relations to these countries, then yes, that might be consequences or there might be impacts on those particular bonds. However, if let's say, you know, you're holding on to a typical, I don't know, a typical Singapore bond that does not have exposure to these countries, this, you know, this geopolitical affected countries, then there wouldn't be much impact lah in terms of your bonds because technically, you know, the company doesn't even, you know, touch that area, or it doesn't even affect the company at all, then it shouldn't affect the bonds in any ways lah. Yep. I hope that answers your question. Okay. What is the outlook of REITs taking the higher for longer rate into consideration? And in particular, is data center REIT more attractive amid AI-driven growth? Yeah. So, sorry if I can't really answer to this question because I'm not a REITs expert. But in terms of REIT itself, because REITs are basically most of the time they're just borrowing money to do more acquisition or maybe more asset enhancement on their pre-existing uh uh uh, uh properties lah. So what is the outlook of REITs taking higher for longer rates into consideration? So as you can see, the REITs might not be doing too well at this juncture because due to the high interest rate environment, and right now it's gonna be slightly higher over for a slightly longer period of time. Hence, I believe that REITs are still taking a hit on that. But I believe that once the yields no once rates starts to taper down, then borrowings will be cheaper for them than REITs. By then will be able to pick back up again. Yeah, so sorry if my answer isn't really that direct because I'm not a REIT expert, but yeah, I hope that answers your question. And also for the second part in particular, is data center REITs more attractive amidst AI-driven growth? Yeah, so for this, right, I would say yes, because due to the AI-driven growth, right, a lot of data, for example, let's say ESR logos, for example, because they are mainly high spec industrial centers or data centers driven. According to the management, yes, they do see demands for their high spec industrial places pick up due to the AI driven growth. So they are hoping to move into that, but that hoping to expand into that space lah. So I believe that if let's say if you want to do a data center play, then with this AI driven commotion that is happening right now, then yeah, you can take a look at that lah. Yep. I hope that answers your question. Uh, why does Poem's bond prices vary quite a bit from Bond Supermart, sometimes even after factoring in spread? Okay, perhaps this I can leave it to Andrew or Bichai to answer this question. But okay, to my knowledge, right, because for them, right, for us, we do charge for our bond prices, right, in the web in our website, we do put a spread inside already. That's why you can see the difference between our prices as well as Bond Supermart price itself. Whereas, yeah, for Bond Supermart itself, it's mainly just an indicative without any additional spread taken from the Bloomberg. I just, yeah, put it out there. I'm no expert, but perhaps Vijay can, help to clarify this question. Yeah. Okay. Why then is Paragon perp trading below par if it's likely to be called? Yeah. So I guess Paragon perp, I believe that, because I would say that I would say there's two sides of the coins. Like there are people, there are investors who thinks that, that maybe, hey, for Paragon, 4.1%, they might not recall. However, there might be the another end, which is like for myself, I believe that, based on the financials itself, it looks there's a high probability of it. And also even let's say we take out what the management says, yeah, just based on financials itself, I think it is sound, and SPH has the liquidity to do so in terms of this in terms of redeeming this 4.1%. Because if let's say they were not to if let's say they did not recall these bonds, for example, and we use the 5-year SORA as a benchmark, which is 3.23%, and 3.24 if we include the spread. So 3.24 plus 2.5%, that will already be 5.9%. So would Paragon want to pay 5.9% as compared to the 4.1% previously? I personally, in business sense, I wouldn't do so lah, if I have the capability to redeem it at a current juncture when I have the capability to do so. But yeah, I believe, on the flip side, some people might think, hey, I don't think they might recall, hence they price it differently. That's why you might get the disparity of this bond being traded below par. Yeah. I hope that answers your question. Okay. Okay. Yeah. Is there any reasons why you're focusing on bonds that are callable this year? Nothing mentioned about bonds that are callable after 2024. Yeah, so like I mentioned earlier, I believe that the tendency of bonds being recalled that are callable this year have a much higher chance due to the fact that, because it's much more expensive for them to reset and to hold on to a high coupon rate for another 5 years time. So let's take example this SPH REIT, which is 5 years SOR, and the next reset would be every 5 years thereafter. So if let's say they did not call back this bond on 30th August 2024, then the next time this coupon rate will be resetted, because if they did not recall this this particular perpetual on 30th August 2024, then it will be resetted on the 5 years benchmark SORA plus an initial spread, which, like I've mentioned, it will give off roughly around 5.9%. And next time they are able to change this coupon rate of 5.9% will be on 30th August 2029. So they have to hold this high interest rate for 5 more years. So assuming that, in 2026, interest rate starts to taper down all the way, let's say, to back to like 1 to 2%, then I mean, what I mean, companies can issue a new issuance, let's say 5 years issuance, and maybe 2%, 3%. But right now they're holding on to a 5.9%. It doesn't make economic sense for them. That's why I said that, I think that, for those perpetuals that are callable this year, it's worth the look because of this of these attributes that I mentioned earlier, of these factors that I mentioned earlier, due to the high interest rate environment. It'll be slightly costlier. It'll be costlier for them to hold on to this new resetted rate for another 5 more years time. Yeah, I hope that answers your question. Okay. Yep. Perhaps this will be the last question as you'll be reaching one. These perps with reset dates in 2024, if you expect most to be redeemed, then these are very short-term instruments. I thought you mentioned it's a good idea to seek bonds with 2 to 5 years runway. Yep, correct. So I mean, like I mentioned, these bonds are worth the look, but like you have mentioned, yes, there will be a reinvestment risk because these are really, really short dated bonds. However, let's say for longer dated bonds, although I did not add it into these slides, but yes, it's still worth the look also for 2 to 5 years duration, because when bond prices right now for those longer dated bonds are trading below par due to the high interest rate environment, once you have locked in all these like 2 to 5 years time, and once rate starts to taper down, then you start to see the prices of these bonds start to pick back up. So I mean, for these two bonds, it's just an illustration that I'm just trying to say that, hey, these callable bonds are worth the look, and it's interesting as well as for those note holders that they are currently holding on to this kind of bonds, might give them some sort of conviction that this perpetual might be callable this year. Yep. So yeah, but do note that don't push away the fact that for those longer dated bonds such as 2 to 5 years time, perhaps currently maybe trading around below par, and they're offering around 3% ish kind of percent or kind of coupon. Yeah, these are still relatively good bonds to lock it in before rate starts to taper down at the near future. Yeah, I hope that answers your question. Okay. Yeah. Okay. I believe that's all I have the time for this session. Yep. You have any more questions? Sorry if I can't answer all of them. Do feel free to email us, or we also have a community chat in our P3 community, which is the bond community. You can post your question there as well, and I'll try to answer them as soon as possible as well. Yep. I hope you guys had an enjoyable session today, and hope that inspires some kind of I don't know thinking for you guys. Yep. Thank you, and see you guys next time.